Kevin Warsh just got nominated to run the Federal Reserve, and he wants to shrink the balance sheet from $7 trillion down to $2 trillion. That's $5 trillion of liquidity that could disappear from the markets. But the problem is, he's been wrong about inflation for 15 years straight. And now Trump also wants 1% interest rates. Now, you can't drain liquidity and cut rates. I mean, that's hitting the gas and the brake at the same time. So what does this mean for your Bitcoin, your stocks, your portfolio? Well, I've got Joseph Wang here. He's known as the Fed guy. He's a former senior trader at the New York Fed who literally executed Fed policy. Now, he's going to break down whether Warsh can actually pull this off, what it means for risk assets, how he sees GDP growth, what AI is going to do to the markets, and the number one thing you should be watching to know which way this is all going to go. So let's just go ahead and just jump right in with Joseph. So Joseph, Kevin Warsh has been nominated as the new Fed chair. Now, it seems like he's sort of been wrong about inflation for the last, 15 years straight. He says he wants to shrink the Fed's balance sheet from like 25% of GDP back to like 5%. Will he crash the markets if he tries to do that?
So if he tries to do that, he will definitely crash the markets. But I want to be clear. There is a path to do this that doesn't crash the market. Now, you're totally right that Kevin Warsh has basically been wrong about inflation for basically forever. But what's really alarming, he's basically been wrong in the same way consistently. He's been consistently too hawkish.
Okay.
So even when after the great financial crisis, which most of you know was really bad, and we had the unemployment rate approach 10% back then, he was like, yeah, the unemployment rate is high, but guys, what about inflation? And we didn't have inflation was not a problem for basically a decade after the great financial crisis. Actually, the problem was that the Fed had trouble hitting their inflation target. So he's been pretty consistently hawkish. Now, the reason he's been hawkish is that he has a view of the world where if you have a very big Fed balance sheet, you're basically printing a lot of money, and that's inflationary. Now, that was kind of a reasonable way to look at the world back in 2009 when the Fed first started expanding its balance sheet. That was a kind of a new thing, and it caught a lot of people off guard, and a lot of people had trouble understanding what it meant. Back then, I remember the gold prices basically went to the moon because everyone was hearing imminent hyperinflation. But that just did not happen. And so that way of looking at the world has turned out to be incorrect. Now, what we did see happen, though, is that it was tremendously bullish for financial assets. So what happened was that because the Fed expanded their balance sheet, bought a whole lot of bonds, that pushed down interest rates lower than they otherwise would be. And so if you are a huge investor trying to find a return, well, 3% treasury yields didn't seem all that appealing. And so you went up the risk curve, you bought some corporate bonds, or maybe you went further up the risk curve and you bought some equities. And that created a huge wealth effect that was intended to stimulate the economy. So QE, expanding the Fed's balance sheet as a tool to inflate financial assets to boost the economy, that was exactly as intended by Chair Bernanke. So it stands to reason that if you were to reverse that, to shrink the Fed's balance sheet, well, that would mean that treasury yields would go higher, right? So that means that, hey, maybe I don't have to go to the corporate bond market or the equity market to get good returns. Maybe I can go back to treasuries, and so you could have a very much a reverse wealth effect. But listen, that is just one scenario. The way they're trying to do this, though, is they're trying to walk this path where you could shrink the Fed's balance sheet without it being risk off. Now, as we all know, the president really likes his stock market, right? He's giving a forecast, Dow 100,000 by the end of his term. It's 50,000 today, so it's, let's say, doubling in 3 years, a very ambitious target. Now, the way that he's trying Kevin Warsh, and to be clear, shrinking the Fed's balance sheet, it's not a Walsh-only idea. It's his personal crusade for over a decade. So this guy used to be a Fed governor, and so we have a lot of data of what he used to say. We have meeting transcripts. He's been writing a lot. He gives podcasts and speeches and so forth. So shrinking the Fed's balance sheet is a crusade that he's been on for ever since the great financial crisis. So this is something he believes in. But Secretary Bessent also believes in this. You have other governors on the Federal Reserve also believing this. So this is a consensus position. This isn't something that they'll say and they just change their mind. This is something that there's a lot of buy-in to. Now, the way that you can do this without crashing everything is you have to make it so that as the Fed shrinks its balance sheet, you need the banking sector to expand its balance sheet and take the Fed's place. And that's that's the plan. And the way they're trying to go about doing this is they're loosening up the bank regs to make sure that the banks are going to be able to uh, either provide financing for the treasuries that someone is going to buy or buy the treasuries themselves. Now, one way they're deregulating the banking sector is basically firing 30% of the people who work in bank supervision. Now, that's deregulation by brute
Yeah.
force. That's a real that's something that's what they're actually doing, but they're also doing it the more normal way by rolling back some of the regulations that happened after the Great Financial Crisis. So the Great Financial Crisis was basically a banking crisis. The banks were too aggressive in their risk taking, and so they made a lot of mistakes. Let's just say, and so after the Great Financial Crisis, the government went really strict on them, made it so that they basically could not misbehave, turned them into utilities, very boring businesses, and now if they can be deregulated, maybe they will expand their balance sheet. And when I say that, that means basically create money. Banks can create money just like the central banks, the way that they did before the great financial crisis. And that's our path towards a smaller Fed without crashing the markets. It's a hard path, uh, but it's a possible path. Otherwise, yes, it will be negative for markets. And we kind of saw a little bit of that a couple weeks ago when Kevin Walsh was, I guess, surprisingly nominated.
If you strip this down to make it super simple for everyone to kind of think through, when you think about a rising tide lifting all boats, so to speak. So when we have more liquidity in the system, it pushes asset prices up, and if you remove liquidity, then asset prices would come down. So number one, is that too simplistic, or does that give us like a framework to think off of? And then to go to like shrinking the balance sheet, maybe people think too binary about this. Well, if you shrink the balance sheet, then liquidity goes down. But what you're saying is, well, there's a whole bunch of different ways you can move things around from an accounting perspective. And so we could shrink the Fed balance sheet, but increase the bank's balance sheets, and we effectively have the same amount of liquidity there.
Yes, yes, that's exactly right. No, I actually, so when people talk about quantitative easing, it is injecting liquidity into the financial system. That is crystal clear. Its effects on financial markets, I think it's really obvious that it makes financial assets go up in price, right? That's kind of the intention. It worked really well. There's a whole bunch of studies on this, and no one really quite agrees with what it does. I mean, as a market participant, someone who makes their living off the market, I can tell you that if the Fed were to announce a huge balance sheet expansion, stock prices will go up, right? Everyone knows
Yeah.
that, so it obviously works. There's some studies that say, yeah, it doesn't really do anything. Some studies do. A really interesting meta study. So a study that studied all the studies on
Yeah.
QE basically decided that, hey, if you work at a central bank, your study concluded that QE is great, it really works. If you don't work at a central bank, your study concluded that it doesn't do anything.
Yeah.
So there's kind of a political element to that. So I think it works. Now, uh, if though you shrink liquidity by shrinking the central bank's balance sheet, the private sector it's also they could also create liquidity by banks, making loans, buying assets, creating credit, basically.
Mhm.
So private liquidity can theoretically replace the central bank liquidity that gets withdrawn.
Back to the QE wasn't inflationary. It seems to be like a play of words, semantics, if you will. I often say that they're factually correct, but intellectually dishonest. So they say that there was no inflation, but home prices went up and stock prices went up. Well, but that's not consumer prices. So that's not inflation, that's appreciation. Okay, but like I'm a consumer and I buy a home, right? So it seems like it's more wordplay because, I mean, it seems pretty factually true that asset prices, home prices, stock prices went up during the QE era. And we didn't see, to your point, we didn't see CPI inflation go up for like a decade. And so that seems to be where some of these academic papers divide, or do you see it differently?
So QE obviously inflates asset prices, right? So what is QE? Fed going out and buying literally trillions and trillions of dollars worth of treasuries and agency-backed mortgages, right? If you buy $1 trillion of anything, the price is going to go up, right? And that's going to spill over to other financial assets. So, and housing is something that kind of trades a little bit like a bond because people buy for cap rates, for yield, right? And so if bond yields go lower, house prices go up as well. So anything connected to interest rates, you basically saw inflation. But you didn't really see any inflation in CPI stuff
Right.
like you mentioned. So when people talk about inflation, yes, they define it as consumer prices, CPI, PCE, whatever index you use, and that's food, that's shelter, that's insurance, that's all that stuff. So it's a broader measure, and we did not see a lot of inflation in that broader segment. But anything tied to interest rates, to your point, we did see obvious inflation, and that was the intended impact of QE to create a wealth effect, and so that people will feel wealthy and buy stuff. And now, if you take that to its logical conclusion, we have the K-shaped recovery we talk about today, where people who have assets benefited from that wealth effect. They continue to spend and support the economy, so that on the aggregate, the economy looks okay. But if you break it down a little bit, the people who don't have assets are not doing well. So it's very uneven.
Hmm. Yeah, it is very uneven. This is going to deviate from sort of some of the questions I wanted to ask you, but while we're talking about that specifically in this K-shaped recovery, a lot of times people might say that, the Fed's trying to fight inflation. Maybe they might say this income divide, the K-shaped economy, is a symptom, or it's a unintended consequence. I might say that maybe the system is working as is intended. And so what do I mean by that? Like, of course, their target is 2% inflation. So that means my purchasing power of the dollar is going to go down. That's what that means, right? I mean, theoretically, I know they hope that GDP keeps up or beats that number, right? But and then we have this inflation, and to the point you made, those who own assets do well with that. Those who don't own assets do poorly. So we have this K-shaped recovery. I might say that the economy and the investing landscape is sort of working as it's intended. The problem may be that with like the K-shaped recovery, there's a K-shape in education and understanding how the market's supposed to work. And maybe a lot of people still have this gold-based, equity-based industrial era lens, and not realizing that we're more in this like debt-based economy where debt and inflation drives asset prices. And so maybe because if you understand that, and you understand I could borrow super cheap and I can buy assets that go up and inflation can work for me and I can limit my tax exposure, and wow, if I know how to play this system, it works really well for me. But then for a lot of people, it doesn't. So I guess what I'm trying to say is, would you say that the system is sort of working as it's intended? And if you know how to work within that system, it works pretty good. But the K-shaped economy shows a lot of people are still sort of thinking about a system that's no longer here. All right, stop what you're doing right now and book your travel to come join me in Las Vegas for the Bitcoin conference. It's the biggest event of the year, the one I look forward to the most every single year. Literally my entire year calendar is set around it. It's the biggest event, the most culturally relevant event happening in the world. The top politicians, the top bankers, the top investors, the top entertainers, everybody's gonna be there. So come check it out, April 27th through the 29th. Use my code MarkMoss to save 10%. And if you use my code to save 10%, send me a message on social media or email, and I'll invite you to a private party I'm having at the event, and I'll see you there.
So we definitely have a system that there's a certain way to play it to benefit. I think part of that is because a system is determined by rules, by tax law, for example, like you mentioned. And those rules are basically made by special interest groups or people who can influence people, lawmakers. And a great example is like real estate, like you mentioned, right? So in real estate, you have all sorts of tax advantages. For example, if you buy something with a mortgage, your mortgage interest, that's tax deductible. But then let's say you're a renter, you don't get that benefit. You have all sorts of other things like 1031 exchanges. And those are really big advantages.
And tax
to people who
depreciation to write off against my income? Yeah.
Exactly. And you got opportunity zones as well. You got all sorts of stuff to benefit people, to help people who know the rules and who can play this game. And so in that sense, you really kind of have to know how the system is structured to be able to become successful. Now, if you don't understand that's what the game is, and this game does change over time, right? I imagine there was a time where you could work hard, go to school, climb the ladder and become successful. But that I don't think that works today. And so if that was the mindset that you were living your life by, you would be very disappointed. And I think that's probably part of the reason why you have this huge resurgence of people who are basically just gambling every day in the stock market or with options or crypto or meme coins and things like that. It's because the former, I guess, social model of advancement turned out to be not true, and they don't really know what's the next one, and they're trying to look for it.
Yeah.
But
Yeah.
yeah, so
It's a knee-jerk
I think that's
reaction.
actually
Oh, go ahead.
that's really bad for society because you really want people to, I think real wealth is being able to produce goods and services that people like, not just kind of speculate and number go up. That is illusory. You can't. If everyone was doing that, who would be producing the real goods and services, the technological advances that actually improve our living standards? So I think it's not a good direction.
Yeah, definitely. And so, Ron Paul and the Fed, we can talk about that, but we are in the system that we have, and we're in the game, and there's little we can do about it. So you talked about this gambling, and you said crypto and meme stocks and things like that. So, not that this question is that, but my favorite asset is Bitcoin. You know that. We say Bitcoin, not crypto. We're very clear to draw the distinction there. But Bitcoin is JP Morgan called gold and Bitcoin a debasement trade, but Bitcoin has been appearing to be much more like a risk asset at this time. So would you say that I guess the question is, everyone thought Trump was going to be this Bitcoin president. He sort of came in and took credit for the price of Bitcoin. He's pushed a bunch of pro-crypto bills through, Bitcoin Reserve Talk, the Genius Act, but Bitcoin's gone down. So now we're getting Warsh, who wants to shrink liquidity. So the question is the new Fed chair going to be good or bad for risk assets like Bitcoin?
Looks like the reaction so far has been negative,
Right.
right? So I'm actually very surprised at the price action in Bitcoin. Like you mentioned, Bitcoin was perceived to be an asset that would benefit from the debasement trade. But over the past few weeks, what we've seen is gold is surging, silver is surging. We have a lot of base metals like copper, aluminum surging, but Bitcoin didn't seem to benefit from that. And the president really has done a lot from a policy perspective to support the crypto world. He spoke at the Bitcoin conference heading up to the election. And in contrast to the Biden administration was very negative crypto. So you really have tremendous support from the public sector, but I'm kind of surprised that Bitcoin didn't really benefit from that. And now if we go on to chair nominee Warsh, I don't think he's going to be supportive of the crypto industry. Like when I read him and when I look at his history, he seems like a traditional guy from a think tank. And these think tank guys basically don't change their mind, right? They're basically ideologues. So they read something in college or whatever, and they kind of say the same thing over and over again, even though a reality proves them to be wrong. So they're not very flexible in how they look at the world. And so today we know that Warsh owes Trump big time for his nomination, and so he's going to have to do what Trump says. But one day maybe there's a different president, and Warsh is free to be who he always has been, a very hawkish person.
Yeah.
Someone who probably was not going to be very open to these new assets. So I think the market took Warsh's nomination negatively, including the Bitcoin market. I think that's the right take.
It's interesting, as I said earlier, JP Morgan calling gold and Bitcoin the debasement trade. But really, I just spoke at this conference in Vancouver a couple of weeks ago called the Vancouver Resource Investor Conference. It's like a big gold and silver conference. It's like 10,000 people there. And this is my fourth year in a row I've gone up there to speak. And the last 4 years, I'm like, Bitcoin's higher, 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 higher. Gold's been languishing, if not moving sideways. And then this year, they all got to say they told me so. And, gold had that big pop and Bitcoin's down. However, the narrative at the gold conference, and I don't want to say every gold person, but I think you would probably agree, the debasement trade, meaning that the government's going to print money, the Fed's going to print money, it's going to steal the purchasing power of our dollars. So we need to buy a fixed asset or a hard asset like gold to protect our purchasing power, right? That's sort of like this narrative. And that's the point of the debasement trade. As they debase the currency, we can buy a hedge like gold and it protects us. But I would say that the data actually proves that's not true. And this is the case that I made at the event. So if you look at the price of gold from 2020 to 2024, which in 2020 we had the biggest amount, I think the highest percentage of monetary stimulus we've ever seen, whatever that number is, I don't know, 6 trillion, maybe it's higher. We saw some of the highest inflation we've seen in, 3 or 4 decades. We got to 9%. And for 4 years, from 2020 to 2024, gold didn't go up. 4 years. So in record stimulus, in record inflation, it did nothing. Now, Bitcoin went up 800%. Now, in the last 6 months, gold has outperformed, although gold and silver are not looking good. I want to ask you about silver in a second. So then it seems like, well, maybe gold didn't move because of record stimulus and record inflation. Gold obviously didn't. So why moving now? And maybe it's not so much the debasement trade or the inflation trade as it is geopolitical risk or loss of trust or something like that in the system that's maybe now causing it. So now we have, Trump, we have continued weaponization of the dollar, we have, tariff, sanction. And maybe it's more of that geopolitical risk that gold's sensing more than the debasement part of it.
So I'll make 2 points about this. So gold is not a inflation hedge. So I think this is obviously something that is, I think it's historical. So there was a period in history when gold was literally money, right? When you buy something, you would use gold or some representation of gold. Now, in that context, if you're afraid of the government devaluing your gold, like say Roosevelt did, or basically devalue the dollar, excuse me, or inflation, then it makes sense to actually buy gold because gold is still money. Maybe the government's trying to do something, but in that context, it makes sense to think of physical gold as an inflation hedge. I think it doesn't really make sense to think of it as an inflation hedge today because we're not on the gold standard and haven't been for a generation. And like you mentioned, when you look at the performance of gold during the resurgence of inflation in 2021, 2022, it didn't really do anything. So that's one point. Now, the second point is, I think, very important when it comes to trading the market, and that is everyone buys and sells for different reasons. There's still going to be people who look at the fiscal deficit, buy gold, and that's a fiscal deficit only goes up. And to be fair, the price of gold has also trended higher as well.
Right.
There are going to be people, boomers probably, who look at gold and buy it as an inflation hedge. That's part of their cultural background. There's going to be a lot of people right now today buying gold and silver because they chase momentum. There's this whole class of investors who realize that, gosh, when something is going up and I can buy more of it, I can really squeeze it higher. We saw that in all sorts of meme stocks. I think the same thing is happening in gold and silver. From what I read, there's a ton of retail traders buying calls on GLD, for example. Probably not today, but when it was going parabolic, that's basically squeezing it higher. A lot of retail investors in China as well, squeezing it higher. So there's a lot of momentum players as well. So when it comes to gold price today, though, one thing that's very different between gold and Bitcoin is that gold is an asset that is susceptible to central banks. So central banks, obviously, huge, deep institutional buyers. You have central banks all across the world, from China, Poland, and so forth, buying physical gold. They're not buying Bitcoin. And so that is a very big distinction that is supportive of gold prices in this era. And the reason why these central banks are buying gold is, like you mentioned, geopolitical risk. We're moving into a world that's going to be more multipolar, and maybe the dollar is not something that foreign countries can fully rely on, because if you do something the United States doesn't like, maybe they make your dollars go poof or something like that, right?
Yeah.
We certainly saw Russia with European countries and the US basically lose access to their foreign reserves. This is a really, really big problem for a country like China. China is a huge exporter. Their export surplus, the trade surplus is $1 trillion a year. So every year, China is basically earning $1 trillion. $1 trillion is a lot of money, and
Yeah.
you have to put it somewhere, right? So you don't have a lot of options. Even if you put a little bit of that in gold, gold is going to get a huge solid bid. That's just too much money, and there's not enough containers in the world large enough to hold it. So I think that's a big driver of gold's outperformance this year, and I think it's going to continue. We have geopolitical risks continue to rumble. You have potential war in the Middle East. The headline today that I saw was that the Chinese sent a destroyer, one of their modern destroyers, to the Middle East. And, there's a armada there from the U.S. as well. So that's a very, very volatile cocktail that is supportive of gold.
Yeah. Yeah, I didn't see that headline today. I haven't seen that yet. And so that's obviously it's not a black swan. Certainly some gray swans. I mean, they could potentially happen, and that could change everything. Now, Trump seems to be a force to be reckoned with. He seems to have a way of getting what he wants. We saw him at Davos a few weeks ago go around and making deals with everybody, and maybe his tactics are somewhat questionable to some. However, he seems to sort of get his way. Now, he's openly been saying he wants rates lower. He's been saying he wants rates down, maybe down to 1%. Right? He's told the Fed nominees to, promise rate cuts or you don't get the job, kind of a thing. Can Trump actually force rates down? I don't want to use the word force. Do you think Trump could get rates down to 1% before the end of his term? Hey, look, you've worked hard to build your Bitcoin stack, but if it's still sitting on an exchange, it's not really yours. You see, the exchange holds the keys to your Bitcoin. Now, if they freeze withdrawals, if they get hacked, they go under, your Bitcoin, it could disappear overnight. Even if you've moved it into a single cold wallet, you're still exposed. Now, that would be one device, one point of failure. If anything bad were to happen, you could lose your Bitcoin. Now, that's why I use Unchained. Their collaborative custody vault gives me the best of both worlds. I hold my keys, but my security doesn't depend on just one of them. Now, this is where security and sovereignty actually meet. You see, Unchained's collaborative custody Bitcoin vaults use a 2 of 3 multi-sig model, which means that you hold 2 keys and Unchained holds 1. That means that you own your Bitcoin, but if you ever need help, their team is there to assist you without ever having control over your funds. And here's what I really like. Unchained isn't some offshore exchange or anonymous company. They're based in Austin, Texas. And when you call, you're not stuck with bots or scripts. You talk to a real Bitcoiner who genuinely cares about helping you get it right. Now, they've been at it since 2016 and now secure over 12 billion in Bitcoin for people just like you and I. Now, that kind of trust doesn't happen overnight. So if you're serious about long-term security and ownership, head over to unchained.com/MarkMoss and use code MOSS10 to get 10% off of your first vault. Because if you don't hold your keys, you don't hold your future.
Oh, I think if you've had a big war and we had a huge stock market crash, yeah, it would be at 1%, but I don't think he wants it that way. So I think the president has more influence on interest rate policy than the market understands. The Fed is basically just a group of people, political appointees, and they're not popularly elected. They don't have their own army. And so we've seen the president squeeze Governor Cook, squeeze Fed Chair Powell, and I'm sure that he's squeezing other people behind the scenes as well. I think I'll just give a little bit broader context here. So for most of history, for most countries, the central bank is part of the government. It does what the government says. In Japan, for example, the Bank of Japan basically did whatever the government did, supported its industrial policies, and contributed to a big boom in the 1980s. And they did not become independent until 1998. In the UK, again, first world country, had been doing very well for hundreds of years. Their central bank did not become independent until, I believe, 1997, and France somewhere in the early 1990s. So it's actually a historical norm to have the government have more influence over what a central bank does. It's basically just a different economic model, more of a coherent industrial policy model where the government has a goal. Oh, let's say for this case, for example, we want to have a remanufacturing renaissance. We want to reindustrialize. We are facing an existential competition with China. And so we need everyone on board to try to support this effort, and that means lower rates. I think that's the economic model that we're moving towards. It's actually the same as the current model in China, for example, where they do not have independent central bank. The central bank does whatever the government says, and the government, of course, does whatever the Politburo determines through their plans and so forth. So it's just a different economic model. I think that's where we're heading towards.
Okay.
I think that we will get lower rates. I think that's probably a large, significant mispricing in the
So
market.
do you think the 1% number is probably how Trump does like anchoring, like throwing out crazy numbers
Yeah,
to
yeah.
settle down? So he doesn't really want 1%. He wants them much lower. We don't really know where that number is. He probably gets them much lower, but maybe not to actual 1%.
Yeah, well, I mean, we still don't have Greenland, right? Uh,
Yeah.
so we have some bases on Greenland, better access this time. So I think that 1% is definitely not going to happen. But here's the thing about central banking: it's not a science; it's an art, right? So I'll give you an example. So let's say that you want your central bank official and you want lower rates. How do you go and convince people to do this? There's a lot of ways you could actually do this, right? For example, what people commonly do right now is you're like, the unemployment rate, we are dual mandate central bank, full employment, price stability. I'm really concerned about employment because the employment numbers aren't great. Unemployment rate is trending higher. All these anecdotal reports about layoffs. We got to cut rates. Or let's say that you're looking at inflation. It's definitely above target. It's been above target for 5 years. But hey, according to my calculations, a lot of the inflation today, it's just tariffs. And we know tariffs are temporary. So inflation is transitory, which is what some people say. And a lot of people use the word transitory during
Yeah.
22 and 2021. Another way you could do this is that, I think that we're super restrictive right now and we should just moderate our stance a little bit. So maybe if we cut rates by 25, 50 basis points, we'll just be less restrictive, right? We're still being restrictive, getting inflation down, just a little bit less restrictive to balance out employment concerns. So there's a lot of wiggle room to actually get an outcome. It's an art, and really, because it's an art, a personnel just sets the policy. So you can easily have a central bank that can go say cut rates 4 times this year, get it to 2.5, maybe 2.25. I think that is totally reasonable. To get to 1% by the end of the year, I think that
Well, I
is
wasn't saying by the
very,
end of
very
to be fair, I wasn't
difficult.
saying by the end of the
Oh
year.
yeah,
I was saying by
yeah.
2029.
Uh, oh, that's a
I
long
said by the
time.
end of his term. By the end of his term.
Yeah, but I have no idea. I mean, anything could happen. But I'm just looking at this
Right.
year in my
Yeah.
context. But I think we can get 4 cuts this year. Uh, the president, I think he is actually demanding 1%, not when he leaves, but right now, before the election,
Yeah.
preferably,
Yeah.
right? So I think he's not going to get that, but he's going to get more than what the market is pricing, which is just 2 cuts this
Yeah.
year.
I mean, the interest rates is, like you said, there's an art to it, and it's accommodated for a whole bunch of different reasons, and some of these reasons maybe compete with each other, but one of which seems to be a massive reason, which is the interest on the debt. And the interest on the debt is one of I believe, our top 3 expenses that we have right now, pushing us into this fiscal dominance period. And that seems like a very good reason to get rates down, if nothing else. Wouldn't that be one of the primary drivers?
It can be, but I have not heard Chair Warsh ever talk about interest rates in that sense. It could be something he whispers, uh, you know, just not to scare the public. But uh, I think so. To your point, right now the federal interest expense is about a trillion or $1.1 trillion annually. It's expected to continue to increase. We just had the latest CBO estimates come out today, Wednesday, and so it looks like it's going to be an even bigger part. Now the Fed makes it worse because as it keeps interest rates higher, how does the federal government pay its interest expense? It just keeps borrowing
Right.
more. So you kind of have that compounding effect. Here's the interesting thing, though. So people like Warren Mosler have been talking about this for some time, and that is when the federal government pays interest, it's basically interest income to someone in the private sector, right? So you end up in a position where, when you hike up interest rates, thinking that you're slowing the economy, you are also increasing the interest income of whoever bought treasuries or whoever lent out money. And so you may end up in a position where your higher interest rates actually stimulate the economy on net rather than slow it down. So you are in the head getting to this perverse place where you're not actually sure what interest rates do to the overall economy. I don't think they'll cut it because they want to make the debt expense go lower. Honestly, when I look at Congress, I don't get the sense that anyone there cares about the fiscal deficit. So I don't think that's why they do it. But in the future, you could end up in a position where the stock of debt is so large that when they want to actually maybe reduce the stimulative impact of the interest expense, they might actually have to reduce interest rates a little bit.
Yeah. Yeah, I mean, I don't think there's any appetite, agreeing with you, there's no appetite to cut the debt. As a matter of fact, I think that the government debt will never be paid. Nobody wants to pay it, and nor should it ever be paid. I would go that far as to say that.
Why government debt is just money that pays interest, right? So
Yeah, I mean, we're in a debt-based monetary system, and so the debt shouldn't be paid. But that also assumes that you can manage the debt, and so that does have to come down to the interest rate that you're paying on it. So there is something there at some point. But what would you say? I think maybe some people have a little bit maybe too simplistic of a view of linking rates and inflation. So, I mean, shoot, if we lower rates, then the economy starts booming and Bitcoin crushes again, but inflation rages. Now, all of a sudden, a hamburger's $25. Well, I think it already is $25, but but you get my idea, right? Is that too simple? I mean, is there a link between interest rates and inflation?
So I'll tell you what I observe. So in the textbooks, that's what they tell you, and that is a very tempting mental model, right? Obviously, Fed raises interest rates, economic activity dampens, and inflation goes down. That sounds reasonable, except that it's obviously not what we've seen over the past 20 years. Remember, after the great financial crises, we lowered interest rates to zero, Fed did QE, and we didn't have inflation. Couldn't find inflation anywhere, begged for inflation, couldn't get it.
Right.
And outside of the country, in the Eurozone, in Japan, they lowered interest rates to negative, right? So they're totally punishing you, begging you to go borrow,
Right.
right? Borrow something, I'll pay you. And they couldn't get inflation either for a decade, no matter what they did. And then after the pandemic, we had inflation. It was very high, so we hiked interest rates up to over 5% in the U.S. Everyone was thinking that we'd have a recession, including myself. But then we hiked interest rates to above 5%. We didn't get a recession at all. We didn't even get any job loss. Job growth continued to be strong. So looking back over the past 20 years, it seems obvious to me that the economy is just not as interest rate sensitive as it used to be. The economy is always changing. The financial system is always changing. So the effectiveness on interest rates and inflation is going to change as well. And today it's obvious that it's just not very strong. Now, we can think about reasons why the economy is less interest rate sensitive, but it's really obvious that it is. A very good candidate for explaining this is that the economy is more services oriented. Now, Mark, let's say that you want to start a podcast, a business or something like that. If you have a nice studio, as I see you do, it's probably going to take some capital expenditures, but still, it's not going to be as much as building a huge factory like they would like 20 or 30 years
Right.
ago, right? So, because a lot of the industries that we have are not as capital intensive, they're not going to be as interest rate sensitive. Now, the U.S. economy today is overwhelmingly services oriented. It could be, being a lawyer, being a doctor, cutting hair, writing a blog, and all that stuff. And you just don't need to borrow as much money to build something like that. And as a result, the economy is just less interest rate sensitive, and so it's not going to be so easy that you toggle interest rates and suddenly you get inflation or you get lower inflation.
Yeah, that's a good analogy. Something that could cause that to be a little bit more is the health of the economy, the GDP growth specifically, trying to sort of balance the inflation rate and the GDP together. We've been languishing in the 2%, 2.5% range, wherever we're at there. Maybe dipping into a recession at some point when Biden was there. I don't know if we calculated the right way, whatever. But I watched Howard Lutnick sit down with Chamath on All In podcast 2-3 weeks ago. Great interview, by the way, on tariffs and stuff. I don't know if you caught that. But Lutnick gave this amazing talk on tariffs and whatnot, which I think if you care about tariffs, you should watch that. But he said that he thinks that GDP would be, in 2026, should be easily 5% and should probably be 6%, which is eye-watering numbers. I believe it was last night, at the time of this recording, February 11th, or maybe it was 2 days ago, Trump came out and said he thinks GDP 15%. And again, that's probably one of his big numbers to move the market. But, 5-6%, maybe higher, I don't know, closer to 15%. Are they completely delusional? Or is there any actual path to that? Governments will never stop printing money, so inflation, it's not going away. Now, if your money's not earning at least 10% a year, you're losing purchasing power. Now, that's why I talk about Bitcoin. It's the number one way to beat inflation and secure your future. And the question I get asked almost every day is, where do you buy your Bitcoin? Now, for years, I've personally used river.com, and I only take on sponsors that I use and I trust. And I trust them because River's Bitcoin only, they have 100% reserve, and they keep your Bitcoin safe in cold storage with no middlemen. And you can actually talk to a real person, a US-based support dedicated manager. Now, try getting that peace of mind from Coinbase. Of course you can't. Now, the perks, if you set up auto buys, you can pay 0 fees. Plus, instead of your bank paying you, 0.4% on cash, River pays you 3.75% on cash paid in Bitcoin. So if you're ready to build your Bitcoin position with confidence, go to river.com/markmoss and get up to $100 in Bitcoin when you sign up. Because freedom starts when you own your money, and your money starts with Bitcoin.
So let's break it down. So GDP is just the amount of goods and services an economy produces in a year. How do you produce more goods and services?
Supposed to be domestic goods and services.
Yes, exactly right. So how do you do that? Well, 2 things can happen. One, you could have more people working, or you could have be the same amount of people just produce more, become more productive, right? So more efficient, more productive. So same amount of inputs, but more outputs.
Or you could
So
have
the
the
first-
valuation of those inputs be more. I still make 10 iPhones, but now instead of 1,000 each, they're now 1,300 each, right?
Well, they try to control for changes in inflation, things
Okay.
like that, but it's hard to do.
Okay.
So you can definitely have nominal GDP go up 15%. They have that in like Argentina and Turkey,
Yeah.
But it's a different thing. So just going on in real
Yeah.
terms, during the Biden era, we had huge GDP growth, largely because we just imported tremendous amounts of people, right? It was like open borders, a lot of people come in. I think the estimates from I believe the CBO was, I don't know, somewhere between 3, 4, 5, 6 million illegal immigrants coming in to the year. So workforce increased a lot, and that really boosted GDP. That's not happening. The president has really damped down on illegal immigration. So our population is not going to be growing that much. So that part is not possible. The other part to have massive GDP growth is productivity. And there is some hope in that through AI. We're seeing a lot of people implement AI. AI is getting better and better. But I think that's still something to be seen at the moment. I use AI in my everyday work, and it's really cool. It does make me more productive. It's easier to search, but it hasn't made me produce more or charge more for my services and all that stuff. So monetization is another thing. So we'll see. If we do have a real AI productivity boom, it's possible to have 5% GDP growth, definitely.
Could you say that AI has made you 2% more productive? 2%?
Yeah,
I mean, you
that's
could have it automatically download the Fed meeting notes or any SEC filing, and it could like summarize it, put it into the format you want, ask the questions, answer the questions. I mean, how many hours would that save you right there?
it ups. So this is actually a really good way to think about this. So it obviously does. Like I can do cool research. Can you look back at the declassified information from FOC meetings and find examples and so forth? That can do that almost instantly, and it would take me hours. So it definitely saves me time. But here's the thing. I mean, that doesn't for me, for someone who writes a newsletter, that doesn't change the price that I charge, and it doesn't change the number of subscribers that I get. So what it does is saves me time that I then can go to the gym or watch TV. So in a sense, the benefit is captured by me having more free time rather than showing up in GDP numbers. So
Well, let me challenge
playing
that.
out for me.
Let me challenge that.
Yeah.
So first of all, if you like, Joseph's a legend. He said earlier like he was caught off guard when the Fed raised rates and he thought the market was going to crash, and even him. But I had him on my show. I think it was September, October of 2022. When the whole world was on fire, everyone's saying the market's going to crash. Harry Dent, of course, is saying it's going to crash 90%. And Joseph came on and said there is no market crash coming, and here's why. And you nailed the bottom. That was like October 2022. You nailed it. Changed my whole view, and I changed my tune moving forward from there. So if you want to get his newsletter, we're going to link to it down below. Now, let's talk about that for a second, though. I understand what you're saying. Hey, now you can just go spend more time at the gym or more time on Netflix or whatever. But generally, most businesses' goal is to grow. So like I want to be more efficient so I can get more output from my people. Potentially, you used to have to hire a high-end researcher, but now I could get 2 lower-end researchers because now they have the tools, right? So you might not, but maybe somebody younger than you, maybe with a little bit more motivations, like, hey, I've gained back 5 hours. Let me start a second newsletter now, or whatever, right?
Yes, that is definitely
Right. So
possible.
now
And people who do that,
instead of what I could do, I can't get more newsletter subscribers, nor can I charge them more. But what I could do is I could add an option service where I pull all these meeting minutes, I ask all the questions they want, I answer them all, and I send that as a side subscription for a $10, $20 a month kicker. So now for almost no additional work, you've added an extra revenue stream with no additional work. And now you're getting some ideas, and I see you're smiling.
yeah, I was like, wow, Mark is a very sharp businessman for sure.
But my point is it wouldn't be hard to see that you can get 2% efficiency gain, productivity gain.
So I guess that the thing is this. So there's going to be a productivity gain for sure. It's just that how does that get captured? Can it be that someone takes their time and just goes out, becomes very ambitious, and goes and builds a new business and other stuff? Then you're going to have a massive boost.
Well, could you look at the market that runs on a 30 times PE ratio and say if they just increase their profitability by 2%? Or they grow 2% more without increasing costs?
I want to say that there's a relationship between profits and stock prices, but I don't really know if that's true. So what we observe though is that, okay, so I look at it in a couple ways. So what we observe is companies are definitely being able to boost their profit margins through this, and the way that they are, what this plays out is you have people basically getting fired because you don't need as many people right now. And so that doesn't really tell me that that's not the impact that you would have when you have a huge productivity boom, right? If you wanted to boost GDP, I mean, because what you would do is that you would actually take those other people, going back to the example that you gave, and have them in different divisions, roll out new products and so forth. But that doesn't seem to be happening. What seems to be happening is that, hey, we don't actually need so many people. We'll just shrink a little bit and use the tools to do the job and boost our profit margins. And so in that sense, it doesn't seem like it's getting that huge GDP boost. Now, here's the next step, though. If we have a competitive marketplace and everyone's margins are boosted, then they're going to be competed away, right? So part of the reason you see this huge implosion in the SaaS companies and even in the financial advisors is that there's fear that you can have these AI solutions compete against these financial advisors and providing.
It's real.
Yeah, so
it's real. They should all they're all going to go away. That legacy business, like enterprise software, it's done.
So I guess the question is, let's say that happens. How does that manifest in GDP if after competition prices go down so much? Everyone has better services for sure, but also prices go lower. And also a lot of people don't have jobs, so they're just kind of sitting around. They could, of course, take advantage of this new frontier, these new tools, and build a new business. Not all of them can do that, but some will. So how does that all play out? I think at the end of the day, the living standards for the typical person are going to be higher because they get to benefit from all this great knowledge work that used to cost a lot, but now can be done immediately by AI.
But yeah, let me ask another way, because this goes into the next question I want to get to. I don't know if you've been seeing all over Twitter, or maybe my feed, that man, the algorithm's so hypersensitive today. But like everything's talking about Claude Bot and Claude Code. I don't know if you've been seeing that. And you can set up Claude Code now, or like your own Claude Bot computer, and it can run all these agents and processes for you. It's like, man, it's like all I see right now, because of course I'm paying attention to that. If someone just learned how to set it up, which appears to be pretty easy, it's probably gonna take me about 6 or 8 hours to try to figure that out. If someone could figure out how to set that up for people, they could make $100,000 a month just doing that. By the way, if anybody's listening, I'll gladly pay you $5,000 if you come to my office and set that up for me, and I'll pay you a couple grand a month to keep it up. Like literally, like, and you get 10 clients like me, right? You're ready to go. That being said,
That's a
let's
good.
move on to the next question. So back to the GDP though, because the way I see it is a little bit different. I look at, whether these numbers are right, or I'm sure they're somewhat over exaggerated, but if we have, $8 trillion committed to reindustrialize the United States, building factories, building plants. We know that all the AI data centers are in a race to build energy facilities. They have to build their own energy facilities now. Massive data centers being spent. We know that the Trump administration, or I should say the DoD specifically, has massive initiatives into critical minerals, mining, refining. We're talking about a massive boom in construction and all those types of things. Supply and demand could dictate that we could see wages and supplies in those areas go through the roof. Especially maybe there's not as many of those blue collar jobs, if you'll call it that, people that can lay the concrete and run the copper wires and all those things. And that might, this is why it leads to my next question, but let's answer this one first. But that might be highly inflationary if we see wages go through the roof like that. But that's also a lot of GDP.
So we see that happening in the data center construction
Right.
build-outs, right? So anecdotal reports says when you have a data center being built in the area, basically all the electricians and all those construction blue-collar workers, they're basically fully booked
Right.
within like a 50-mile radius because these data centers are enormous. So that there's definitely wage inflation in those sectors. But the broader part of the U.S., though, is services sectors, and those are the guys that are going to maybe lose their jobs because of AI, right? They're the back office, compliance, accounting, lawyers, or just general corporate stuff, right? So blue collar work is a minority in the U.S. economy, and I can imagine a scenario where they have consistent wage growth, and that is inflationary, but that's just one segment of the overall economy, which is services oriented and is not going to see wage increases because of AI.
Okay.
Unless, of course, you're an AI researcher who wants to work at Meta, then you have tremendous wage inflation.
Yeah. Technology changes the way that we work and operate, and we don't operate in a vacuum. So technology has always created more jobs than it's destroyed, but it does create disruption because people do lose their jobs and they have to be retrained to learn something else. So there is disruption. I believe there's more jobs on this side, not less. But yeah, what do you do with the people? When we first had in the 1789 in the Industrial Revolution, we had a machine that can go do the work of 5,000 men in the field. What do those 5,000 men do? Eventually, they did science and medicine, which was great. But in the beginning, like, how do we get from there to there? And especially, it's happening very rapidly. But
No, Mark, you make a really good point. I mean, technology has been advancing rapidly for like hundreds of years, right? And yet we still all have jobs, people who want jobs. So exactly right. People don't work in the fields. People don't type and word process the way they used to, but they find different jobs, and it is a disruptive process. And that's what looks like we're going to go through in the next few years.
So I wanted to go back to Warsh and inflation because if we were to get 6% GDP or closer to whatever, 8, 10, 15, like Trump said, you said something like, that could put us more towards Argentina or Venezuela, something like that. And so it seems like it's been sort of like the Fed's policy that wages going up, American people earning more money is inflationary. And when Powell started talking about taming inflation, it was like, well, let's raise rates, which will put out a few million people out of work. And that will bring the wages back down to fight inflation. And it seems like, and you're the Fed guy, not me, but Warsh seems to have maybe taken a different stance on inflation, specifically around wages. And I think I've read some stuff where he's like, well, maybe we need to sort of recalculate or rethink how we calculate inflation, and maybe wages going up in a demand environment where we have to build data centers or whatever, maybe that shouldn't be inflationary. So I guess number one, have you seen that, or did I misread that? And do you think he would calculate inflation metrics different?
He could have said that. This is actually a really good question for AI, which can immediately search everything he's ever said and tell us immediately. So,
Drew? Yeah.
so I think that, first of all, the Fed, their inflation mandate is 2%, but what you want to keep in mind is it's not from Congress. It's just it's just a target they decided themselves in 2012. Before 2012, the Fed, didn't even have an inflation target. No one knew exactly what they thought was consistent with stable prices. It's possible they could just change the inflation targets to something else, from PCE to CPI, from 2% to maybe a band, let's say 1 to 3% instead of just 2%. That would give them more flexibility to let things slide whenever they feel like it.
I want to go back to, because I think I saw on an interview you did recently, you talked about how you were able to clean off your crystal ball enough, and you were able to exit silver right before we saw this massive crash. So how'd you know? We saw maybe a bubble forming in silver, and what does that tell us about Bitcoin?
Well, silver went up every day, every day, every day. So that's kind of a sign of a bubble, right? It looks like it gets parabolic. So I had actually set some physical silver bars, and I went to try to sell them to try to cash out because this is just looks really frothy to me. When I went to the silver dealer, there's a long line of people trying to sell silver, physical silver. There, everyone was taking out their heirlooms and all that, trying to cash out, and that kind of immediately struck me as, whoa, this is not going to be sustainable because you have all this supply coming online. There was only one person in line to buy silver at that time. It was a Zoomer, so someone who had not seen bubble phases before. So after I sold my bar, I wanted to sell the bars the next day because it seemed so frothy. I went to another dealer and they actually told me that he can't buy it from me because he's totally full. Like he bought all the silver he could, bought his vault is overflowing, and the people he sell to can't give him money until 2 months later. So totally oversaturation. So that was a really really big red light to me that something was happening. Just basic trading though. Come on, if you look at the history of silver, it goes up periodically to really really high prices and then it just implodes. So it looks like that was just happening. Now, I think Bitcoin, though, is a little bit different. Bitcoin, let's be clear, looking at its price history, it goes up a lot and it goes down a lot. You have these crypto winters. It's something that happens periodically. What's happening to Bitcoin, it's hard to say if it's out of the ordinary or not. But one thing that's different from Bitcoin is that Bitcoin has, in my view, the biggest negative risk to it was that the government would try to, try to tamp down on assets that compete with the dollar. But actually, the opposite happened. You have an administration that is fully embracing crypto, that loves Bitcoin. And so to me, that takes away a lot of the existential tail risk that would happen to Bitcoin. And it's going to be an asset that really does have a purpose, right? A lot of it is to moving money, evading sanctions, and so forth like that. But I think that it's something that has value. It's a great network. It has a huge support socially and politically at the moment. It is disappointing that it has not been a debasement trade thing, and and many people perceived it to be. So you might have to have a new set of buyers come in with a different view of what it's for, and for them to gain influence. I think for it to recover.
I love that. Just boots on the ground, old school research, just going into the silver buyers and sellers and seeing what's going on. So check this out. Saved me a couple hours here. From Warsh's November 2025 WSJ op-ed, the Federal Reserve's broken leadership. He said he rejects the Phillips curve framework that treats wage growth as inflation. He said the Fed, quote, the Fed should re-examine its great mistakes that led to the great inflation. It should abandon the dogma that inflation is caused when the economy grows too much and workers get paid too much. Inflation is caused when government spends too much and prints too much. And he goes on to talk about credit and Main Street, whatever. But that's where I read it. So the dogma that inflation is caused when the economy grows too much, 5, 6, 8, 10%, and workers get paid too much.
No, that makes sense. Yeah, that is traditional economic thinking, right? Economic thinking is that wages are a large part of the costs of a services company, and so when wages go up, maybe that gets passed through when you get broader
It's
inflation.
pretty evil when I hear the Fed wants to slow inflation down, so let's just make sure a few million people lose their jobs. Like, what? We should let people make more money. It shouldn't be something that we're fighting against. That seems crazy. So I don't know.
The dogma is that the workers would prefer to have lower inflation. I'm sorry. I mean, would it's okay because they have high unemployment temporarily because inflation is worse. Inflation hurts more people, but the polling suggests that people are okay with losing their jobs because they can handle that. But inflation, they have nowhere to hide.
Mm. I've asked people, and of course, my sample size is skewed because I'm at conferences around investing and whatnot. But when I ask people, would you rather a game, a choice? Would you rather your house, your retirement account, your assets, everything gets cut in half. Your business drops, so your business doesn't do as good. But gas prices and food prices drops 10%. Or would you rather your business make more money, your asset prices double, and your gas and food prices go up by 10%? And of course, everybody chooses to have my asset prices double. Like nobody wants to see all of their life get cut in half, their business drop to save a little bit of money at the gas pump. Um, like I said, my sample is skewed because I'm talking to people who own assets. And so if you don't own assets, maybe it's a little bit different. But would you see it differently?
Well, I would say that when inflation is high, the incumbent loses the election, right? We saw that happen in 2024. We saw Argentina elect Milei, which is some guy who carries around a chain skull because they didn't
Yeah.
like inflation; it was too high. So I think the broader public is really upset when inflation is high probably because they don't own
Yeah.
assets.
Yeah. All right. Well, we covered a lot. I think we'll wrap it up here. Man, I always love talking to you. What do you think people should be paying attention to the most as we go into this new monetary regime, if you may call it that, of a new Fed chair, the Trump administration? What do you think people should be paying attention to?
So, as a professional Fed watcher, I have to sadly say that going forward, the Fed is just not going to be as important as it used to
Wow.
be. Going forward, what you want to be looking for is what happens in the White House, what happens in Congress, because these are the guys that are going to set the rules and tell you which are the industries that are going to do well and how to invest. Right. So you want to focus on which industries are being favored. Tax policy, deficit policy, these things are going to have a much bigger impact on asset prices going forward than whatever the Fed does, which, in my personal view, is just going to be whatever the White House tells them to do.
Okay. So watch the Trump administration, watch the politics side, more than just looking at, is it 3.25 or 3.65 or whatever?
Remember, the president tweeted out, "Now's a good time to buy," in the April Liberation Day massacre, and it was a really good call on his
Yeah.
part.
So just watch his Twitter account. All right, Joseph, thanks so much. Again, we'll link to your newsletters down below, your new YouTube channel. Congratulations on that down below, so everybody can check that out. Anything else you want to draw attention to before we wrap it up?
No, thanks so much for having me, Mark. It's a pleasure to talk to you.
Okay, thanks.